Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. Today's outlook is for the week of April 1st, 2019. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. And if you like what you hear with today's Market Talk, please feel free to subscribe to this channel or visit us at Bull Profits Daily, a Banyan Hill published daily e-letter. So this past Friday's release of U.S. personal spending results for January and personal income for February came in just slightly under expectations, but did show an advance over their previous month's reading. Both prints are likely a result of a three-pronged factor. Per Bloomberg, the first is the market sell-off we experienced in fourth quarter last year, and the second is the aftershocks of the government shutdown earlier this year, and lastly, smaller U.S. tax refunds, all having a direct impact on personal spending. Now, once these temporary factors are overcome, spending can power forward. And there's significant data underpinning this forward sentiment. One of them being the Bloomberg U.S. Financial Conditions Index. Take a look at this chart. This index charts the overall level of financial stress in the U.S. money, bond, and equity markets. This index helps measure the availability and cost of credit. A positive value shows favorable financial conditions, while a negative value shows tighter financial conditions relative to pre-crisis norms. So as seen in this chart, as of today, the index is in favorable territory. It's showing that financial conditions have rebounded post-fourth quarter U.S. financial market decline. And at its most recent low on December 24th of last year, the index fell to a negative 1.117, and it's showing a positive value of 0.684 right now. Now, to put this in perspective, as seen with the red arrow in this chart, the index plummeted to a low of negative 12.564 in October of 2008. So that's just one telling chart, but here's another one. The U.S. Commodity Futures Trading Commission, or CFTC, and Bloomberg is showing that the bulls are back. This chart compares the S&P 500 index to the CFTC Chicago Mercantile Exchange E-mini S&P 500 net non-commercial futures positions. And it's showing that for the first time since January, it's turned in a positive direction. This is indicating that speculative U.S. stock bets have turned positive. So using these two indices as a measuring stick, the markets are moving in the right direction. And with that being said, we have some key economic releases this week. As you can see in this graphic, preliminary February durable good orders for February, obviously, will be released on Tuesday, April 2nd at 8:30 a.m. ADP unemployment change for March will be released on Wednesday, April 3rd at 8:15 a.m. And the March jobs report will be released on Friday, April 5th at 8:30 a.m. Now, switching gears, we have an ongoing theme here at Bull Profits Daily of how we are living in a unique period in history where there's a massive paradigm shift with whom we're conducting business with, now and in the future. And our theme is how new world companies are steadily replacing old world companies. And a new data study from Second Measure, a technology company that literally analyzes billions of anonymized credit and debit purchases to answer real-time questions on consumer behavior, is proving our theme correct. Check out this chart. Second Measure's data is showing how yearly sales at Airbnb, a major online marketplace that lets people rent out their properties to guests, have surpassed Hilton hotels and resorts. And in all, annual sales at Airbnb increased 12-fold from 2013 to 2018, while Hilton sales remained somewhat stagnant. And it's also worth noting that yearly sales at Airbnb are also gaining on Marriott International, even with Marriott's acquisition of Starwood in 2016. So lastly, as this graph shows, our disruptification index continues to do well year to date. As of Friday's March 29th close, the index is up 23.9% versus 11.3% on the Dow and 13% on the S&P 500. So that's it from me. Ian, what are you watching today?
Thanks, Amber. So a few things I'm watching this week. So from a macro perspective, last week there were a few really good numbers that came out. The first one that I want to touch on is the new home sales for February. So new home sales in February grew about 4.9% versus the estimate that was expected to be 1.3% growth. So that was well over what people were expecting for new home sales. And that's really, really bullish for home sale, the real estate market, as well as for construction. And this is the fourth straight month that we've seen growth in new home sales of at least 3.8%. And that's pretty big growth when you're considering the home sales for an entire country, especially like the United States. And over these 4 months, the total growth has been 19%. So this has been a really, really bullish market for the economy. And like I said, this is really good for the construction industry as well. And in that month, the actual amount of homes sold was about 667,000. And that is the third most of any month since 2007. So not only was it just an okay month or a good month from the 4.9%, it's historically good from the amount of homes that have been sold since the financial crisis and the real estate bubble burst. So that's one piece of data that I found really encouraging from last week. And the other one is consumer sentiment. The Michigan Consumer Sentiment Report was released last Friday, and the reading on that was 98.4, which is right around the recent highs that we've seen from that index. So just to put that in perspective, right after the financial crisis happened, this number was down around 50. So it's about double that right now. We're very healthy. And like I said, this is right around the new highs that we've seen over the past year or so for this index. And of course, consumers making up 2/3 of GDP, we want to see this number remain high in order to continue to be bullish about the economy. Mm-hmm. So just from these two pieces of data that we saw last week, and we keep seeing more week after week, we remain very bullish. We continue to disagree with the fact that a lot of people are saying that a recession is right on the horizon. And just a few months ago, people were expecting a recession for 2019. And instead of that, we've been seeing record home sales and very healthy consumers. So we expect this to continue. On the disruption front, what I'm looking at right now is telemedicine. So this is something that's really having an impact on the multi-trillion-dollar healthcare industry in the United States. It's also having an impact on how healthcare is conducted on a global scale. So this is basically where a patient and a doctor can communicate. Instead of in a traditional way, they can communicate via something like a video call. And this is really convenient for the patient in a lot of ways. This can really take the place of a lot of different appointments. Like if you go to the doctor and they say to come back for a follow-up, this can be a good replacement for that, because usually those are just routine 10 to 15 minute checkups. It can also take the place of minor things like a cold or allergy appointment. And there are hundreds of millions of these types of appointments that happen every year. So instead of driving to and from the hospital or the doctor's office and waiting in line once you're there, you can just get it all over with in about 10 minutes in a phone call. So not only can the consumers benefit from this, but the physicians we're seeing also are really starting to move over to this side of the industry in huge amounts. There was actually a report that came out around the midpoint of 2018 that said at that point that 51% of primary care physicians in the United States had adopted this technology just to stay competitive. So that's a huge signal that this is really something serious that's going on in the healthcare industry, which, like I said, is trillions of dollars. Just the fact that they want to stay competitive in doing this. So a lot of people are switching to that, which means that a lot more are going to want to not get run out of business. So they're going to be switching to telemedicine as well. There's also the fact that about 50 million people in the United States live farther than 10 miles away from their closest hospital. So it can cut down on travel times, and a lot of these hospitals are in urban areas where there's a lot of traffic. So it just is hugely convenient for both sides, both parties in doctor's appointments. So this is actually growing a lot faster than what people anticipated as well. Back in 2011, there was a report that came out that said that telemedicine in general was expected to be a $6.3 billion industry by 2020. And of course, $6.3 billion is a pretty big industry, multi-billion. But so far, we're seeing the numbers really blow past that. And last year, it was actually estimated at $38.3 billion. And now the new estimate for 2025 is $130 billion. And about half of this right now is expected to be in the United States. However, we expect this to be able to grow very quickly on a global scale as well, as things like smartphones and stable internet connections and high-speed internet continue to grow globally. And this is already happening, as last year we saw the amount of people with high-speed internet or internet connections all over the world grow by 300 million people. So we're seeing a rapidly growing market for this. We're seeing a lot of people already adopt it, especially here in the United States, and we really expect that to continue. And this is also something that we have a recommendation to be able to invest in our True Momentum newsletter. So it's a great opportunity to get in. And you can get that, like I said, with True Momentum. So, Paul?
Thank you, Ian. And in fact, in last week's True Momentum update, I actually mentioned that this stock is looking really, really good right now to get in. And later on in my part of the update, I'm actually going to mention another incredible stock that we're going to be releasing tomorrow. So stay tuned. So let me go first on the macro level and sort of touch on things that Ian and Amber have touched on, which is that interest rates have been like the big thing that everybody's been worried about really for a year now. And last week, Larry Kudlow and Stephen Moore, I believe that's his name, who's being nominated to the Federal Reserve by President Trump, they're calling for 2 rate cuts, which is probably optimistic in my judgment. However, to me, what that does say is that this interest rate hiking cycle is done. You can stick a fork in it. It is completely, utterly gone forever. And not just for like a year. I believe it could be for 3 or 5 years. So that is unbelievably optimistic for housing because, of course, interest rates are such a big part of that. And interest rates are really critical, so important for housing because, of course, we're borrowing a lot of money and even a small shift in interest rates can mean a lot. It also means a lot for business lending. Just think through the eyes of a small or medium-sized business owner that's been watching the Federal Reserve increase rates and telling people, hey, we're planning to increase them all the way till the end of 2019. Well, I know if I was running a business, I'd be like, well, you know what? Hold off a little bit because, I don't know how people are going to take to significantly higher rates. And so what it does is that it obviously gives us low interest rates, but even as importantly, it gives us stability. It gives us certainty on what is going to happen. And that allows people to make decisions, whether you're a homeowner, whether you're a business owner, whether you're a farmer planning to buy a big piece of equipment. So all of this is unbelievably optimistic, I believe, for the economy and also for the stock market. So Ian and I and Amber have been discussing what has been going on in the stock market for about the last month or so. And what we've been seeing is that people really have been in some ways setting themselves up for the opposite. They've been buying stocks that would be good in a slowdown or a recession. So things like utilities have been bought by investors, consumer staple stocks. In other words, like the safety play. That's what people have been bidding up. And in truth, when we look at our companies in terms of their business and also what's going on with the trading patterns, the strong hands, as I like to put it, have been buying the growth stocks at cheap levels And now when the crowd comes in to buy, they're going to have to bid them up. And that's, of course, going to be great for our subscribers who are invested in these stocks. And as you know, if you've been following us, we told you to stay in all through 2018 when all the scare stories were telling you to get out, when all the gloom and doomers were telling you that, you know, some enormous disaster or catastrophe was happening. So our subscribers have benefited from the upswing. However, the big gains, I believe, are still ahead. And speaking of gains, Lyft, the IPO that we mentioned to you last week, it came public last week, and it surged higher as much as 20% on the day that it opened. Eventually ended up closing up 9% or so. However, that's a really good performance for the company. And I actually had a lot of people reach out and say, hey, Paul, should we buy Lyft? And what I have been telling people is that, well, IPOs have a very particular trading pattern because the bulk of the shares are still unsold. And so there's these demand and supply issues that you really have to take into account. And the stats are that something like 90% of all IPOs revisit their IPO price. Now, I have no idea if Lyft is going to be one of those exceptions. However, we're going to track it. And if we think Lyft's a great buy, it'll be in one of our services. I promise you that. So speaking of our services, I want to mention that we are closing in on our big push for True Momentum, which is our best performing service. I haven't looked at the latest numbers. However, it's annualizing at some crazy rate, something like 35 or 40%, some massive winners in there of 150, 200% or more. And we're closing in on a big push for this. And to reward the new subscribers on Tuesday, we're also going to put in an absolutely phenomenal, unbelievable stock. Now, this stock, I think of it as being the Intel of electric vehicles. In other words, you're going to need a lot of these and you have to have them, and to make them more powerful, to make them more energy efficient, to make them last longer. These are the things that are going to help improve it. And because of it, I believe the amount of these kinds of chips that are going to be bought are going to skyrocket. And I believe it's going to take this stock with it. So that's something for you to look out for, True Momentum, and for this stock, which we're going to release tomorrow. So quickly, some news about big companies. Tesla is supposed to report their sales numbers. People have been very negative on Tesla. You know, we're positive on Tesla. I've been positive on Tesla really for 3 years now. And it's pretty clear that this is going to be the leading electric vehicle automaker in the world. And I believe that stock could go up if the sales numbers are good. So that's what's going on with Tesla. Many of you know I've been negative on Apple, and I actually get quite a bit of hate mail from people who are positive on Apple. However, I have to tell you that things seem to be going from bad to worse at Apple. They just pulled a highly anticipated product. It's not a big product, however, it's highly anticipated by a lot of people, which is their charging mat. So you could charge your iPhone, iWatch, and EarPods all at once, and they kind of pulled it really without telling people. And it turns out they had a lot of technical difficulties in doing it. And I believe it's a sign at what is going on at the company, which is that they are really struggling to do what people pay them for, which is to delight them with beautiful devices that really make their lives easier. And they're struggling with innovation with their main platform products, the iPhone, the iPad, and their iMac computers. Now they're even struggling really with the smaller things, which such like this charging pad. I saw also an incredible stat which affects Facebook, which is another popular stock that's out there, which is that in a few years, really by 2024, 61% of all media spending will be digital. And that means it benefits Facebook and it benefits Google. These are the two companies that really dominate online digital advertising. And that means that the outlook is incredibly good for these companies. And equally, there's always a downside to this, which is it's equally bad for the old media of newspapers, television stations, radio stations. So that's some companies in news. Also want to do a quick crypto update because from my perspective, crypto is the new side of money. And so I keep close track of what's going on with Bitcoin and all the major cryptocurrencies. And I saw something that Ripple, which is a new emerging platform for crypto, and Indian Bank is partnering with them to use their technology. That's pretty incredible when you think that, this is a technology that's barely 2 years old. I also saw that Facebook is creating its own blockchain unit and hiring for it, which is pretty crazy. And Square is also creating its standalone crypto unit just to help the crypto movement get more acceptance. So enormous amount of momentum is in there. And you know that we have blockchain as one of our major megatrends, and we have a lot of stocks that benefit from that. And the last piece of news on the crypto side is Coinbase, which is like the New York Stock Exchange for crypto. They are considering paying interest on your Bitcoin and other cryptocurrencies. So another really big development. So that's all I have. Back to you, Amber.
Thank you so much, Paul, and thank you, Ian, and thank you to our watchers for tuning in this week. We appreciate you, and we want to wish you a wonderful week. And until next time, take care.